Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. We are back on the Energy Desk. It is November 15th, around midday. How's it going, Zane?
Good to be back. It's my favorite part of the week, Alex.
Oh, yeah. Yeah, we've got some interesting stuff this week. I think one of the bigger ones that we've been talking about is some fudgy numbers and various OPEC and DOE reports for crude supply and demand. I think maybe starting on the OPEC piece, we can talk kind of at length about the overproduction that is being reported and kind of some opaque numbers that don't necessarily add up in all the different sources that we're seeing. Is there any part in here that you want to start with?
I think it's just a broad statement to begin with. One of my longstanding favorite things, said tongue-in-cheek, maddening for the analytical world. When you can go back and pencil whip history and make it whatever you want it to be, I guess what's the point of talking about tomorrow when you get to change what yesterday was? So there is that thematic statement to begin with. And before covering the supply side, which is clearly about all that people care about right now in the way of what OPEC has to say, the latest monthly oil market report issued on Monday, November 11th, on good old Veterans Day here in the U.S., showed a downward revision to demand in 2024. That has been the consistent theme over the past 4 reporting periods, and this being the 5th, dating back to July. And yet again, here we are with the downward demand revision. So it was a pretty equal change to 2024 and 2025, about a couple 100,000 barrels a day of demand revised lower, and that keeps the year-on-year growth static. However, it is simply less demand for crude barrels. As we transition into 2025, and please note that the one period that has been left hanging out there by both the DOE and OPEC is one period not to touch with your eraser and going and revising what you had previously said is Q4 of 2024. And so here we are at this point, squarely in the middle of it. And how 2024 demand ends up shaking out, and the only way it can really be measured is inventory changes, mind you, outside of the US and Europe and some products in Southeast Asia. The ability to measure inventory or hear a report from one that is capable of actually seeing it themselves is a bit challenging. So the demand side, still generally a negative, more downward revisions from OPEC. And with that, I'll kick it back to you to launch us into the supply side, the topic that people probably care more about.
So, on the OPEC monthly report, it's been a consistent theme that we've touched on the Energy Desk in previous episodes, but the overproduction for the voluntary cuts that have been pledged since 2 different periods in 2023, but really the 2 that are top of mind are Iraq and Kazakhstan.
Oh, look, you're just like everybody else. You're going to leave the UAE out of it. They're the biggest overproducer, and somehow they managed to slide under the radar. I don't know who the UAE's got dirt on, but somehow they're left out of the headlines. Sorry. All right, back to the 2 that, yes, everybody focuses on, so let's stay there. Kazakhstan and Iraq.
Yeah, the 2 headline numbers. And so the numbers here, as we mentioned at the beginning of this, they vary quite a bit. And when you go back into OPEC's monthly reports for previous months, the numbers are changing pretty consistently. And so it's hard to get a clear idea of what's going on. But the latest production number for Kazakhstan came in at about 1.29 million barrels per day. And this is where for October, correct. And this is where the debate comes in, where I guess the headlines are saying that Kazakhstan's overproducing still by 90,000 barrels per day, despite having maintenance work that was expected to bring them under their voluntary quota. And ultimately that maintenance started late, finished early, and they were able to bring production back online. And so I guess this is an opportunity to dig into those numbers. So at 1.29 million barrels per day, headlines saying that they're overproducing for October's quota by about 90,000 barrels per day. And I think that when we look at those numbers, I guess from September's 1.582 from OPEC's numbers, I guess you got a different number from there. That was about
163. So it's back to what was history. The initially reported numbers for September stated that Kazakhstan hit an all-time high of 1.63 million barrels per day, which the comparative point, if you go back to September 5th, and welcome all listeners to go dig this up themselves on OPEC's website under press releases. You can go back to the one dated September 5th, and they'll give you a nice clean table of what this voluntary cut crew was expected to produce for October, November. They left those together as one reporting period, December, and then each bullet month of 2025. The stated number for Kazakhstan's target in October and November was 1.468 million barrels per day. So therein lies the confusion. At, like Alex said just a moment ago, at 1.29, you would clearly be under that threshold. And so what's the measuring stick that we're using here? Is it the month-on-month decline that was expected?
Right.
Is it the table issued on September 5th? And I think thematically, the storyline is still intact regardless of the confusion. And listeners, we could certainly confuse you more, but we're going to try to leave it as simple as stated thus far. And the theme here is Iraq, Kazakhstan, UAE, a few other small overproducers. To me, one of the most important points here is that there have been consistent statements made by OPEC, and Alex, maybe you've got some more color on the actual commentary in the release from Monday, but I'll just start with the statement that's been clear cut is that these overproducing nations would make up for the 2024 overproduction by September of 2025. When you go back and you look at how much each of these overproducers has delivered, that would require virtually all of the overproducers to drop output to very near 2020 lows for the majority of 2025 to make up for 2024. Sorry, we're right back to the confusion. And then if you take that table issued on September 5th by OPEC and the stated targets for each of these countries, it is well above what would be required to make up for 2024. So which one is it? And I don't know that we have an answer yet.
Yeah, and the kind of funky accounting of numbers there is, I guess, one of the, if I was to steelman the overproduction argument, is if we are saying that number is not including the compensation figures that Kazakhstan and Iraq have pledged, then maybe they'd be still overproducing by quite a bit. And when I just do the quick back of the napkin math on accounting for those compensation numbers, then we have a cumulative overproduction for Kazakhstan of about 550,000 barrels per day so far in For Iraq, that number is a little bit higher. And purely using OPEC's latest numbers that clearly state cumulative overproduction for Iraq and Kazakhstan, that number is about 2.14 million barrels per day for those two. And so it's a pretty substantial number. And I think that maybe that points to this supply demand uncertainty. And I think that especially comes into focus when you look at Kazakhstan planning to bring on their new expansion that is going to add roughly 260,000 barrels per day by 2Q 25. And I guess that also raises the question, are they going to be able to bring that back on when they've been overproduced?
They've been kind of Iraqi production, and often the swings between there's less than people expected or there is more comes from the Kurdish region in northern Iraq. And I guess maybe I'm not going to consider myself in any way Iraqi political expert, but the conflict between the Kurds, the semi-autonomous region of Iraq, and call it the Iraqi mothership, is always going to make that one a challenge. We've had pipeline issues, whether man-made or just some actual mistake, accident. But, again, not going to even pretend to have the clear-cut answer on that. But both of these places, like you mentioned, if Kazakhstan's got a new project, are they just going to sit on that and let those dollars that were spent be recouped at a later date?
Right.
Maybe, but would that theoretically be at a lower oil price? If prices are here or higher, here, obviously, a relative point. It's Friday, November 15th, and these 5 minutes using the comparative data points for WTI and Brent, the January WTI contract is trading at an even $67 a barrel, and the corresponding Brent contract at $71.14. We see Iraqi and Kazakh production going, like all countries, probably as a function of price. And will you make up? Yes, I will make up for the overproduction if we are sub $65 a barrel Brent. Yeah, I bet you will. At $80 Brent, will you make up for it? While probably simultaneously saying, clearly the market wants more barrels now, so we're just going to go ahead and give the market these barrels.
Yeah, you make an interesting point, too, on the Iraq front, where you have a lot of brewing instability between Turkey and the Kurds, which is a long-standing disagreement with the Turkeys, with the PKK, which is a group that is related to one of the U.S. allies in the region. But just last week, I saw that Turkey is hoping to take a more direct action against some of the groups that are working on the border. And I think that adds to this kind of uncertainty picture with what might happen with some of the Kurdish barrels that have been locked up with pipeline disagreements and some of the other. So definitely not a clear takeaway yet, but I think one for the listeners just to keep an eye on as we see some new dynamics evolve in the Mideast, especially with Trump coming in for his second term. But with that, I think it's an opportunity to bring it back to one of the points that you brought up earlier this week when we're talking about the mismatch between OPEC supply and DOE reported supply, and maybe any final thoughts on that.
Before we get into that topic, I'm going to say thank goodness for uncertainty. If things were certain, what in the world would we talk about on these podcasts? Yeah. Or would we at Mobius even have a place in this universe of helping people figure out what tomorrow is? If you knew what tomorrow was, I don't know that this would be relevant. Okay, so let's come back to the home front and let's talk about the latest DOE monthly update in the short-term energy outlook. So the status quo is a lot like the moment in time at the same juncture last year, where if one were to take the DOE supply outlook and pair it with the OPEC demand outlook, you get very different outcomes, or the inverse. That's maybe a topic for another conversation. For now, let's stay on this month's DOE short-term energy outlook. It came with no material revisions. However, as a reminder of what has been issued for several months now, there is one critical point. The DOE expectation for supply in 2025 is for 2 million barrels per day of year-over-year growth. That is, as of this release, going from 102.62 million barrels per day of global production in 2024 up to 104.66, or a little bit over 2 million barrels per day. Their expected demand growth for 2025 is a far lesser 1.22 million barrels per day, or going from 103.14 up to 104.36. So you've got, and depending on how you want to look at this, there's plenty of ways that people will debate, what constitutes oversupply. So we can take the simplest approach. Supply 104.66, demand 104.36. That's more supply than there is demand. And then you take the year over year comparisons and it looks even more dire there's 800 million barrels per day more supply growth than there is demand growth. And I think the trajectory into 2025 based on the DOE's outlook is also really troubling when you look at the details on their supply outlook, in that they've only got 500,000 barrels a day of projected OPEC year-over-year growth. And then without going back down the OPEC monthly oil market reports rabbit hole, the OPEC themselves are essentially saying we will grow 1 million barrels per day. Certainly, one may argue that, yeah, but they may keep kicking the can down the road. They may. Like the discussion earlier about Kazakhstan, at some price, I'm sure they will make up for the overproduction. At some price level, I think it's quite possible the DOE could be right. So is the DOE telling you without telling you that we expect prices to be lower? Or are we sandbagging and are not acknowledging, I guess sandbagging is not the right term there. Are we ostriching, sticking our head in the sand, still involves sand. Are we sticking our head in the sand and not acknowledging what OPEC has stated in very plain data issued multiple times in various sources of reporting that's been issued? The outlook for oil, certainly muddy. If anything, still a bit of a bearish lean for us, with the one caveat, and I think you covered this really well last week, and maybe just give people a quick recap on where the spec community stands. There will be more data in a couple hours this afternoon. Again, this is Friday, November 15th. The one caveat to this not so great S&D outlook is spec positioning. So quick recap on that, maybe as of Tuesday, November 5th.
Yeah. So last week's reporting period, so for 2 weeks ago, Tuesday, where we're looking at an increase in spec length that I think was a little bit more cautious. We're coming off of that period that we've talked about a few weeks ago on the energy desk, where we had record low spec open interest. So longs plus shorts, as you mentioned. And again, for total crude complex for ICE and NYMEX, one of the things that we saw this week was that specs net length added the equivalent of 125.76 million barrels week over week. So just make that a little bit more simple for listeners so we aren't too data heavy. We have net for that combined crude complex at the 10-year 6th percentile. And that's really driven by longs that are at the 3rd percentile and shorts that are at the 71st percentile. And then that's coming off of a period where we had that really elevated long short skew. So low longs, high shorts. And I think that there's a little bit of that indication where specs are still uncertain about the downstream effects of the election and what that really means between the U.S. relationship with OPEC and the sanctioned barrels from Russia, Iran, Venezuela. So still pretty low open interest on, say, WTI, but a little bit of a positive movement last week. So I don't know, do you have any thoughts on where that would head?
Yeah, I think the key takeaway from that is it wouldn't take much positive news to get a material short-term rally.
Right.
So what would one do with that? In that sort of crude-led, meaning non-product-led rally that was headline-driven, or maybe some inventory or some country that experiences a material supply disruption, that kind of rally that got sidelined bulls springing to action would be a really important opportunity for those with natural long interests to consider reducing exposure, because we still don't see anything fundamentally that says, yeah, there is a structural step change coming back to the market. Right. And keep in mind, like the shape of the curve, which we covered this week in daily market update, it has become remarkably flat. We can't certainly say that it is literally flat, but when you've got monthly spreads of less than a quarter out multiple years, there's very little shape in the TI curve right now. And that short-term bullish news item that can get the market going, I think, is certainly a possibility.
Yeah.
It's hard to find the really rosy outlook right now with the ever-present, as you mentioned earlier, geopolitical risk just hanging out there somewhere. And I don't know, for me, I think that's a wrap on the oil market with not a whole lot of new news this week, unless you got something else. You know what? There is one other one. Why don't you kick us off on some thoughts on maybe I was thinking just the dollar, but maybe the dollar and equity markets.
Yeah. I think the dollar, I'll talk more on the dollar and the relationship with what's going on with some yields, which I think is an interesting dynamic to watch. So for listeners who haven't been watching, the dollar index, which a basket of 6 other currencies, or I guess maybe 8, I have to check that number, but dollar is rallying, especially after November 5th. Trump elected. People are calling this the Trump trade. I think there's some nuanced dynamics that are contributing to this. So on one end, people are expecting some impact from potential tariffs, especially on export-centric markets that we've talked about at length in our research archive, but also I think a little bit last week. I think the other thing that is contributing to this, though, is how yield spreads, which are related to the tariffs, but how yield spreads are comparing between, say, U.S. sovereign debt and other countries like Japan or South Korea and some of the kind of export-centric markets. And so those yield spreads between the U.S., those are widening. So people are chasing that yield. That's causing capital outflows. People are chasing the dollar. That rally, I think, brings an interesting question that we can come back to what's maybe driving the yields. But this dollar rally up to 106.58 for the dollar index today, that's up 6% from October 1st. And it's one of those questions that we have where the dollar only matters when it matters. It's a confusing statement, but it's hard to extract maybe a meaningful contributions from, say, the dollar being really rich, what that does for importers. And yeah, I guess I think it'd be interesting to hear you explain, extrapolate some thoughts for, is the dollar going to matter in the near term supply uncertainty environment?
Yeah, I'll even argue with myself on does the dollar matter, which means I'll certainly debate anybody else on it. In theory, like the way that the argument goes is the dollar is strong means it costs more to import a U.S. barrel. In theory, should be an inverse relationship, stronger the dollar or the weaker crude. But then you also have plenty of times where you see the two marching higher together, see 2022.
Right.
And then I think the other just interesting contextual point is you just mentioned how we've seen a 6% rally from late September, early October. Just a little more context, I think probably good to stick in the show notes for this week is just a graphic going back. You can even go back a few years. Obviously things were not great anywhere for virtually all of 2020. Well into 2021. And then it wasn't until the spring of 22 that you got the dollar index starting to peek its head back over 100. And then we made a move up all the way to 114. That was along with the entire global BTU crisis, ripping every form of commodities. And in this case, the dollar was a 1 correlation, not a -1 correlation. And then the dollar came down along with crude into early 23. And then since the spring of 23, the low is back at 100. Mm-hmm. We dipped just below it in the middle of 2023, which is like an interesting point. It's one of those reference dates for voluntary OPEC cuts. And then we go back up to 106. So we're at the post-spring, if your clock started at spring of 23, at 106, we're at the highs over that time period.
Yeah.
And so what does that mean for U.S. crude exports? Now, honestly, low confidence. In some respects, we have to export the barrels. We can't keep them all here. So does that begin to impact coastal diffs, which then lead back into supply basin diffs? We've seen some interest pick up in de-risking diff exposure from U.S. producers. And that is warranted in our view, while we've pointed it out to many of our clients. And it's been in some ways fallen on deaf ears when you go from a mid-cush diff of plus $1.25 down to plus 75 cents. Is somebody losing sleep at night? No. But directionally, certainly you've seen some contango open up in the mid-cush curve. And I don't know, my take on it is that I don't know when the dollar will matter. I read something this week that I thought presented a really good case. Like you see currencies rise when a new tariff implementing regime gets established. And then ultimately the wind comes out of the sails.
Right.
In a lot of ways. It maybe is a parallel to what we talked about earlier with like a spec driven rally in TI. The dollar rally right now, it just feels like it's being pulled along with US equities, the Dow, the S&P, the NASDAQ, everything hitting recent all-time highs. I don't know, it feels like you can say that at least once a quarter for the last several years. There was a definitive post-Trump victory rally in U.S. equities, and the dollar was going right along with it. And I think that point you make about yields is really crucial.
Yeah, and there's a lot.
The dollars are... Go ahead.
Yeah,
Sorry,
and
go for it.
there's some really interesting stuff for listeners to dig into here, where starting in the latter half of August, one of the metrics when we look at the spec positioning side for yields that I've thought is quite interesting is the basis trade activity. And so really what we're looking at on that front is this leveraged fund positioning for different futures, say just looking at 2-year, 5-year, 10-year T-note futures. Those combined reached a record short position of over $1.15 trillion of notional value, so face value of the contract. And that's, I think it was 700 billion when you had the reports from the Federal Reserve coming out pointing to the risks of this leveraged basis trade. So people shorting T-note futures and they're long the cash bond. And so I think that the big question in there is how the repo rate fits into that, because when you have this short-term rally in yields, so I guess just pulling up some of the data there, since October 1st, 2-year yields from the Treasury daily par yield curve are up 73 basis points. 5-year is up 81 basis points. 10-year up 69 basis points. And just from the election day, you have 2-year up 13 basis points, 5-year 10 basis points, and 10-year T-note, 10-year yield is up 6 basis points. And so that short-term rally there, I think, brings into question this basis trade activity and how that might have to unwind and what that does to yields. I think that's partly why we're seeing such rapid movements, because we have repo rates that are making that financing cost a little bit tougher for the leverage funds. So I think that there's some really interesting dynamics. We won't dig into them too far here, but I think that there is some risk to watch where you have prolonged yield staying elevated for a prolonged period. And what that does for the dollar, I think, is supportive, especially when you have most other central banks cutting rates because you have economic weakness. So a perfect example, European Central Bank trying to cut rates and go across the board. Really, the big concern is what is that yield spread? Because if they widen that yield spread, then they're going to risk capital outflows to the U.S., which then accelerates currency weakening and makes that issue a little bit harder to navigate. So the ones that I'm watching, you have the yen, which has been an issue for carry trades, which is another kind of related point, but the rupee hit record lows in the last week and go across the board where central banks are having a tough time to say, hey, how are we going to stabilize our currency? South Korea saying that they're going to have to be more active to stabilize. So I think that is maybe the question. And how does that dynamic between U.S. and foreign central banks play into the cost of energy? And
it's a really good segue to gas.
Yeah.
Like, it's something we almost never talk about, like how do currencies play into the export of U.S. gas? Because at this point, yes, there is a facility that is still an importer. Sometimes this U.S. facility in the Northeast is an importer of U.S. gas because you can't get enough in that area by pipe. But it's a good segue to what's going on in European gas pricing. And then in general, the one that you pointed out there that I think is the most fascinating is a depreciating rupee. Mm-hmm. If India is the country that at this point, both oil and gas markets point to often as this is the next China.
Yeah.
And if it gets that much more expensive to import the energy needed to make all of the things that they are going to make and then send back to us in the way of finished product, is that a headwind? Yeah. I think it's an interesting one. And with that, I don't know, maybe start us off on what you're seeing and thoughts on the European gas market. And maybe I'll come in behind you and talk about the Asian gas market.
Yeah. So I think we discussed this a little bit on last week's episode, but Germany and the broader European continent had the first seasonal instance of Zane's favorite word, Dunkelflaut, which is just this anticyclonic weather condition where you have calm winds and cloudy skies. So for a continent that is increasingly pushing for renewable dominant electricity generation, you are then looking at the risk for solar output dropping considerably and wind output dropping considerably. And we saw that last week where Germany's wind fleet was basically cut by 99% in just 2 days. And it held there for a couple more days. And that passed on, obviously, demand for thermal generation like hard coal, lignite, and natural gas. And the downstream result of that we saw this week where you had European gas inventories posting, I guess, from a rate perspective, their largest seasonal draw since 2016. So just in a short period, went from above 2023 inventory levels. Everybody was pretty satisfied with European gas stocks over 95% before the Nov 1 kind of target date for 90%. So well above their target there. Now you're below the 5-year seasonal median, and it's just been 2 weeks. And so I think that's been a really strong driver of something that we talked about on yesterday's webinar, where that fear really changes the sentiment. And we see that priced into front month Dutch TTF, which hit close to a 12-month high yesterday. And I think you have some thoughts on maybe Dutch TTF relative to Asia, some interesting dynamics going on.
Yeah, and I think Alex's recap of what we covered last week, and yes, my favorite word, the Dunkelflaut. Wind factors in for sure when gas is the alternative in a lot of respects. But really any region of the world, and is definitively true maybe more in the northern hemisphere than the southern, it's been colder than normal the past couple of weeks. Mm-hmm. So you go through this little momentary period of incredibly low wind output, which calls on more gas-fired generation. And then you've got a Novi 1 through Novi 14 period that's colder than normal in all of Eastern Europe, Spain, Portugal, southern France, parts of the UK, Scotland, Ireland are still above normal, but a meaningful portion of Europe's been colder than normal. So I think what that highlights is the lack of connectivity with Russian MMBTUs flowing via pipe. It wasn't 4 years ago. It was like, oh, we're going to get Nord Stream 2 and there's going to be all this flowing supply. And then everybody knows what happened since. So colder than normal, and you get this really sharp rate of change. What if it stays cold? What's going to happen? And then just the context on TTF itself, using some concrete numbers, you've got on a rolling prompt month basis, like you mentioned, you're 14, I don't know, probably 1450. We'll use a round number there for a rolling prompt TTF price. We do one touch of $15 in MMBTU back in November, December, or late November of 23. Mm-hmm. So there's your 1 year reference points. We're almost there. And then that's a rally on a rolling prompt month basis from a price tag of $7.25 in February of 24, essentially doubling. Mm-hmm. And that's a rolling prompt. And then you can say, well, that's not fair because there's seasonality in gas curves. That is very true. So let's just take the December or current prompt month contract and look at it by itself. So last November, the forward December 24 contract was $16.65. Bottoms at $9.26. And here we are today, and that same rolling prompt, we're trading December prompt. So you're a little less than $14.50. So meaningful recovery, whether you're looking at it one contract in isolation or seeing the rolling prompt. But then that is the segue to me, what is the most fascinating piece of this, and that is the relationship between TTF and JKM. So the prompt JKM contract is currently $13.50. It's slightly above that, give you a few pennies above that. You can take the January contracts because the expiries aren't even. TTF January is trading $14.50 precisely, and you've got JKM at $14.25. Mm-hmm. So how does that work? If both markets, the JKM market and the TTF market, are reliant on US MMBTUs flowing on a big supercooled tanker, either across the Atlantic or through the Panama Canal and the long way over to Asia. Clearly, it costs more to get an MMBTU to Asia than it does to Europe. So while there's a slight premium measured in dimes per MMBTU, the fact that it costs at least $1 an MMBTU more, depending upon the time, the price of diesel, whether you're shipping it with a gas-fired ship, rabbit hole to go down there. But those are not supposed to be at parity. Mm-hmm. Europe's supposed to be at a slight discount, meaning $1 or so. Maybe make some arguments for 50 cents, sunk costs and all. But the fact that it's trading positive to Asia, certainly with all we've talked about in respect to the European economy, is a fascinating topic in that, yes, like the webinar we did yesterday, are we at a point where we're about to turn the corner and Europe's in freak out mode again? Because remember, it was Europe that kicked off the 2020 global BTU crisis. Yeah. And you covered last week the power pricing. I can't say for sure because certainly not a meteorologist. Study it and love to watch the number guessers go on what they think temperatures are going to be. And I think the key point here is the U.S. gas market, while it had a nice rally on Monday of this week, got hammered yesterday with some big warm midday model changes. You've got the Q1 25 strip here in the good old US of A trading below $3 an MMBTU. And it makes one wonder, is there a sympathy rally if Europe stays cold? And then certainly the almost incomprehensible, what if it were cold in North America because it's been so long? What if there was a gap closing on a move higher? Gas markets can and always will move faster than crude and product markets. And certainly we feel like it could be about time for that to occur. And then I can go on too long on the Europe-Asian gas stories. Let's come back here. And now let's talk about a very micro environment and go back into the good old Lone Star State and talk about power markets and how they relate to gas.
Yeah. So it's a related point to what was going on with Europe last week with weather conditions, but the shoulder season wind output, which for ERCOT is typically the strongest period for wind generation. This week kicked off the week with ERCOT real-time power prices hitting a peak of over $1,300 a megawatt hour, which is 82-day high when you're looking back to about August 20th. And for kind of peak demand hours, that average for November 10th was about $540 a megawatt hour. So what's causing that? We had wind output fall from over 19,000 megawatt hours on November 8th to just 530 megawatt hours on November 11th. So that difference is about minus 97%. And so I think the price side is interesting, but I think more interesting for me was the day over day change in wind output and kind of the speed at which that changes. There's a lot of interesting things that we can talk about there. But the one point that I'll make is that from that low on November 11th to the next day high, you had a difference of about 21,000 megawatt hours. So for context, the one that I like to equate that to is just how many homes can that power. So 21,000 megawatt hours, about 21 million homes for 1 hour. So pretty considerable change for just about 24 hours. And I think that brought about some interesting connections to the spot prices that we discussed earlier this week. And I think it'd be interesting to hear more of those thoughts.
Yeah, it's still this really fascinating environment where one can look at a Q1 25 strip at less than $3 and say, yeah, the market's already given up on winter. Or it's how far above tomorrow's physical pricing could a forward month be? This morning was a fine example of it. After a steep sell-off at the front of the NYMEX natural gas curve yesterday, we come in this morning and early trades at the hub and even more importantly, Houston Ship Channel are very weak. Now, it's a Friday, so you're trading for the 3-day package, Saturday, Sunday, Monday. Very weak, meaning considerably below $2 for the hub. But early trades at Houston Ship Channel were $1.20. So Ship Channel's trading $1.20 an MMBTU. Like NYMEX is trading $1.75. So there's a big spread between those two. Now that gap narrowed here later in the morning. We got, I'll call it back to normal, 15, 20 cent spread between ship channel and the hub, but both well below $2. And that was, by the way, that was ship channel moving back to $1.50 or better, not the hub moving down. Wind is strong for tomorrow. Whatever the opposite of a dunkelflaut is.
Yeah.
A dunkel flip. So you've got strong wind generation for today, for tomorrow. The weather is still mild. Looks like that could be changing. Some big model flip-flops in just the past couple of days, significantly colder outlooks on overnight heading into Thursday. And then Thursday midday, massive warm flip. Overnight, big cold flip. So there's back to the uncertainty topic. Spot pricing, however, is just definitively been quite weak. And with spot pricing as weak as it is, until there is some meaningful weather-driven demand and an improvement in spot pricing, how far could near-term forwards go? And then let's even forget about the back of the gas curve right now. And then that to me is like where I'd like to transition to two topics that I think are almost being just kicked to the curb right now. With spot pricing weak, weather's been remarkably mild. Yes, production went down sub 100 BCF momentarily when Rafael moved across the southern Gulf, shut in some Gulf production. Texas had some blips on some outages on pipes taking MMBTUs from West Texas to the Gulf Coast. Yes, all of those are the headlines. Those are the ones that are grabbing the market's attention. Almost left, ignored right now, are what's going on in consumption from the power sector and the LNG exporting fleet. Sorry, I'm running with this one for a minute. I think these are really important for people to hear. So November, month to date, we are setting, unless there is some big surprise from the generating facilities you don't get to see that aren't connected to an interstate pipe, but from the data that is available, it would appear that November is decidedly setting a new November record for consumption of MMBTUs from the power sector. Yes, wind factors, we covered it plenty, but all regions. When you plot power burn against temperature, the scatter plot right now looks like the chart's broken. You've got some of the strongest burns seasonally that really you ever get. So there's that, and somewhat a function of those low spot prices. That helps. If December currently trading 281 versus the number of days sub $2, is that going to be enough to materially reduce power demand if December in fact does price near that level in the daily market or even in the month ahead market? You look back over the last several years, it didn't matter if we're trading 650 or we're trading 250. We burned more. So my general thesis is, no, it won't matter much. We'll just keep consuming more, just like we have many months in a row. That is a tightening factor for weather-adjusted S&D. And then the latter point is the LNG exporting fleet. We've climbed above 14 BCF a day after limping along all summer. Now, 14 BCF a day is not year-over-year strength, so it's not necessarily a tightening factor yet. We got up to 15 late last year into early 2024. So late 23 into early 24, we were around that 15 mark, and we're just over 14 now. So why are we not back to 15? You've got two facilities, essentially, Sabine Pass and Calcasieu, that are below their levels they were running at when we hit 15. Everybody else clicking on all cylinders. The much maligned Freeport facility, and don't place any bets on it staying at these levels, but all-time highs for Freeport. And then lurking right there in the background, you've got the new Venture Global facility, the Plaquemines exporting facility in Louisiana, that appears to be imminently ready to enter service. Mm-hmm. And I think, to me, one of the headlines this week that would say that is a matter of weeks away, not months anymore, is there were headlines stating that they were expecting to have an initial public offering.
Yeah.
So would you be going public if you were in any time in the near future going to have to say, oh, nope, sorry, this thing's going to be much delayed.
Right.
And then you've got Corpus, an addition at Corpus, which is part of the Cheniere fleet. Also right there waiting in the wings. Now it's got a series of mini trains. So Corpus's first little mini train is not going to be a game changer in any way, but those mini trains come in relatively rapid succession. So I guess the point we're making on these two is if I've got power burn running significantly higher than any period historically for this time of year, and I could get back to or above that 15 BCF a day level before the end of the year, it sets the market up for a jarring move higher. And back to the initial point on spot pricing, only when spot pricing goes. Mm-hmm. So it's a painful waiting game for those with natural long interest and for those with natural short interest or the consumer. Sharpen your pencil, take another pass, have a look. Am I really comfortable with the amount of open exposure I've got right now, knowing that I can mitigate the front 4 months well below $3 and worry about tomorrow? Today, that's the opportunity. And if that proves to be unnecessary insurance for the consumer, and in fact, that period, meaning December through March, December 24 through March 25, ends up pricing off at 250 or lower, then there is going to be a fantastic opportunity for the consumer to look out over multiple years. The producing community will not be able to survive another warm winter without going and selling the back of the curve, which right now you're back over 360 for a 3-year strip out of Jan 26. Can you look a little closer at mitigating the risk for now to buy yourself time on what's later?
Yeah. Yeah, especially as you talk about that weather adjusted supply that we spent plenty of time discussing on yesterday's webinar. We don't have to dig into that further. I think maybe just encourage people to go check that out if they're interested. I think that's probably a good opportunity to leave it. And if anybody has questions, feel free to send those over. And as usual, we'll throw any of the relevant data that we talked about today into the show notes so you can follow along if you're interested.
Thanks. Good being with you, Alex.
Yeah, likewise. Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.